Good afternoon, everybody, and welcome to Taking Stock on Vox Markets. This is Graham Neary. Another busy Wednesday in the UK stock market. So we've got updates from Next, Domino's, Aston Martin, Wix, and lots of small companies as well. Altitude is in there. Inspiration Healthcare, Mulberry. So plenty for us to look at. If you're new, please subscribe to the channel. If you if you're watching this in the live chat, please keep your comments coming. I find them very interesting, and under the replay as well. So you're very welcome. So let's hop into the news. Let me know if you have any suggestions for where you'd like to start. Um, I'm going to start with a company that I personally own shares in, uh, which is Next. So here we have the Vox Markets homepage, and let's hop into Next. So I've owned shares in this company for quite a few years. I do owe the idea to Paul Scott, but I ended up owning the shares long term then, which I don't think that he did. Um, and they've been a pretty decent performer. Uh, I'm a huge fan of the buyback strategy, and I think many people will recognize Next as being the company with uh, one of, if not the best, investor relations capabilities in terms of how they explain what they do to investors. It's absolutely first rate. Um, so we can get a glimpse of that in today's trading statement. And you'll just see how well they explain what they do and how they're performing. This is just a very short trading update, really. But even in this short update, they are way ahead of other retailers and other companies in general, just in how they explain things. So we've got the 13 weeks to April, the 27th of April. So they break down full price sales versus total sales, which makes it a very logical thing to do. So full price sales up 5.7%, slightly ahead of guidance, which was 5%. Another feature of Next is that they almost without fail will under promise and over deliver. And I suppose it just leaves a nice taste in the mouth when they are able to do that. Sort of the opposite of um, many companies in that sense. And look at how profitable they are. Profit before tax expected to come in at 960 million pounds. So this is a company that is absolutely run for profits, not for revenue growth or anything like that. It is run to earn a good return for its shareholders. And I think, uh, yeah, so I mean, if I'm just looking at the historic track record here, even in a very difficult retail environment, they have continued to grow. And one of the really nice aspects of Next, which I like to highlight, is that they're in a position to buy up competitors cheaply when those competitors fail, which sort of makes them like the last man standing in a tough retail industry. So anyway, the full product sales here are up 5.7% for this 13-week period. Online, doing slightly better, well, doing very well, 8.8%, while retail, that's physical retail, not budging at all. And then they also get this this added benefit of finance interest income, which is definitely an important contributor to the whole thing. And then we've got very clear guidance, which they reveal in the statement. So you can see exactly what they're planning for, what they hope to do. And as I said, £960 million of PBT, profit before tax, on total sales of £6.2 billion. So in what could be quite a low margin business, if they didn't run it so ruthlessly, they've actually generated a very, or in general, they generate a very good profit margin and very good quality metrics as well then as a result of that. So as you can tell, I'm a huge fan of this company. I am talking my own book, but I do think it is a class act. Here they break down full price sales guidance for each quarter that's coming up, which is very helpful as well. And that's basically it. It's a short update. Not going to spend much longer on it, but I think it does highlight the the way that Next reports to shareholders and how clear it is. And yeah, so I'm a fan, and hopefully I will still be holding this share many years from now. Fingers crossed. I do try to hold shares for the long term, and I've been holding Next shares for many years now. I'd have to go and check my records, but it's a long time. Okay, so that's Next with an inline update for shareholders. Let's stay with the big caps for now. We will be doing small caps very soon, but let's do another high quality big cap. So Next had a market cap of 11.5 billion. Now Domino's Pizza only 1.3 billion, but still quite a big company in the UK market. And this is really the example, the flagship sort of example of a successful franchise business. And a lot of smaller franchise businesses kind of copy what Domino's Pizza does. I think that's fair to say. No need to explain what they do. I'm sure you're all very familiar. But then we have this trading statement, and it's a little bit lukewarm, let's say. Like-for-like sales down 0.5% in Q1. Now, we've been making the point in this show that 2024 is showing some signs of improvement as it progresses, and Domino's Pizza sort of reiterate that theme where they say February and March was strong while January was weak. So there was that strengthening. However, coming forward to April, I think we've got an outlook statement down here, or we've got some points about April where that might be a little weaker, perhaps. Let's see, where have we got the point about the football? Let's see, Control F. Yeah, so they do expect to benefit from the Euros that are coming up this summer. Of course, plenty of people will be buying a pizza to enjoy with their friends during that tournament. And they say here that trading in April was slower. So as I said, this is a bit of a mixed bag from Domino's. It could not too much to shout about here, but it is at the end of the day an extremely successful business. And let me just check its valuation metrics for you. Trading at 15 times earnings and with a very long track record of profitability. I do think that this is sort of a blue chip stock in terms of being very, very high quality. They also talk about selling their London corporate stores to some franchisees, so that will boost returns. I think they have very few corporate-owned stores. I think it's nearly all franchised, so they just have a few London corporate stores they're going to sell. They also bought some franchised stores in Ireland. I think that was last year, and they are going to presumably get them franchised again at some point, but they've bought them for now. See, there's this mention of it down here, unlocking a significant opportunity for us in Ireland, and we are now in an even stronger position to accelerate our growth, open new stores, etc. So, still quite ambitious. I think they have about 1,200 stores, Domino's, across the UK. So, if they're looking to open another 70, in fact, in excess of 70 new stores being opened this year, that is a decent addition to the 1,200 existing stores. So, still looking quite ambitious. And, for what you would assume it was quite a mature business, but they're actually making quite ambitious noises there in terms of growth. So, I'm I would say I'm pretty positive on this one. A little bit weak, lukewarm in terms of current trading, but at the end of the day, a brilliant, successful, long-term investment there for many people, and looks like it will continue to be a very profitable company long term. Now, I wanted to mention something that I've generally been quite negative on, Aston Martin. These shares are down 4.5% today. Let's check out what we've got here, financials. So this company has been it's been a financial train wreck, frankly, and they have Q1 results here for March, and more losses, which is no big surprise. Now, they do mention their credit ratings. They've had to refinance recently, and they've got a new revolving credit facility. And they mentioned that they've had rating agency upgrades. Now, I've actually looked up their credit ratings this morning, and as far as I can tell, they are currently rated B minus at Fitch, and they are rated CCC plus at S&P. Now, remember, you have to be triple B to be investment grade. So these are quite far away from being investment grade. And the CCC plus at S&P, in particular, that means that S&P considers Aston Martin to be vulnerable. Not highly vulnerable, but vulnerable where they need a positive economic environment. They need things to go in their favor in order to be able to repay their lenders. So that is quite worrying. And it means that, when you have debt which is rated so lowly, you really need a huge return on the equity to justify an equity investment. So you really need a very low share price. Now, the market cap here is still over £1 billion, which, I would suggest that is on the generous side, given the track record here of constant losses, and what is going to change, what is going to result in any improvement here. You can see the operating loss actually increased in Q1 2024. The adjusted EBITDA actually fell. So, there's nothing very positive here. Volumes down 26%, revenues down 10%. It's very hard to find positives in these numbers, I think. Now, in terms of what they're planning, they do say that they're trying to get leverage down to 1.5 times EBITDA. Let's see if I can find that here. 1.5x. Yeah. So they say that through disciplined strategic delivery, we expect to continue deleveraging towards our net leverage ratio target of circa 1.5x. Now, as I've said before, 1.5x is a fine leverage multiple for many companies. However, I would say that for a very capital intensive business with a poor track record, I would not really be able to stand behind 1.5x. And actually, I'd want it to be less than 1 in this case. You can see net cash interest is expected to be 120 million pounds in the current financial year. So, if you're paying 120 million pounds in interest and you're not really generating any operating profits, I just don't see any way out here. But look, good luck to anybody who does own this share. My big picture view here is that the people who invest in Aston Martin are a bit like the people who invest in football clubs. It's very glamorous. It's probably a lot of fun depending on your level of involvement with the company, but it's not. It's not a serious investment. Unfortunately, is my view. So that's Aston Martin, but maybe it will prove me wrong. Okay, let's do Mulberry. I like this theme because I'm a Burberry shareholder long term, and not only do I hope that Burberry will get taken out at some point by Louis Vuitton or somebody else, I also think that Mulberry should get taken out because it's a very small company, really. Market cap 57 million, annual sales only less than 200 million. So it's quite a small company in the luxury space, and you would think that at some point it would just get taken out and bolted into a larger group who would be able to run it better through economies of scale, say. So, this Mulberry Group makes handbags. If you're not familiar, I certainly don't own any Mulberry handbags, but they are, they are very, very high margin goods, and Mulberry has made a profit in the past, not always, but it has an okay track record. I do think they could be far more profitable within a larger group than as a standalone business. So anyway, here we have the year-end trading update. And they say, against a backdrop of challenging macro conditions and a decline in luxury consumer spending, group revenue declined 4%. And I would probably focus on this 2.7% decline, which is at constant exchange rates. Before I go any further, I should mention that Mulberry does have a very low free float. So that could result in a highly volatile share price, if things change here, because most of the company is owned by the family of an Asian billionaire. And then we've also got Fraser's involved, who own a decent chunk. I think, yes, Fraser's owns 37%. So given how strategic Mike Ashley is, at Fraser's, I think that is quite significant. And there's probably, quite a lot of planning involved there. But anyway, Mulberry says they've maintained their gross margins. They say losses for the full year will be impacted by opening new stores and et cetera, et cetera. Retail sales were in line with the prior year, driven by growth in Europe and the United States, with a decline in the UK and Asia Pacific, which continued to be challenging due to the macro climate in China and reduced footfall across the region. So this is a good share if you like to have a Chinese exposure. One of the things I like about Burberry is its exposure to the Asian consumer as well. So just a nice little theme to consider here. CEO comment says, Mulberry has not been immune to the broader downturn in luxury spending experienced in recent months. Looking ahead, the trading environment in the UK and China remains challenging, and we do not expect this to change in the short term. So, not the most straightforward of investments, but the free float here is probably only worth about £6 million or maybe less, depending on how you count it. So, from a trading point of view, it could be quite interesting. When things go its way, I would expect the stock to really move, but the stock has been in a downtrend in the last couple of years, so I must acknowledge that. But this was a share I used to think was horribly overvalued, and I used to always say, "Oh, Mulberry is a great company, but it's overvalued." Market cap now only £57 million. It's only a fraction of what it was trading at a couple of years ago. So I do see value. I do see value in Mulberry, I must say. Okay, let's hop in and do a couple of smaller companies. We've got this share, Annexo. This is a credit hire and legal services group focused on providing replacement vehicles to consumers who have been involved in a non-fault accident. So the credit hire business is called Edge. The legal services business is called Bond Turner. I hadn't studied this company much before today, and I was quite impressed by the value metrics. If you look on Stockopedia, it's trading at a PE multiple of only 4 times, allegedly. So, we look at the return on capital employed here, looks quite good. Certainly cheap, you could say, from a quantitative point of view. But what is the catch? Well, I think there definitely is one or two. There are one or two catches here. So here's a number that's worth focusing on for a moment. Trade and other receivables. And I must tip my hat to Paul Scott, who pointed this out before. Trade and other receivables have grown very, very large in recent years. You can see over £200 million of trade and other receivables. Remember, the market cap here is only £75 million. So an enormous receivables book. Now, I'm sure that this company is absolutely perfect from an ethical point of view, but I used to study Quindel quite a lot, and that company which I shorted had it was the same kind of business, I thought, and the receivables book did expand, and ultimately it was proven that Quindel had some serious problems. Now, Annexo, you can see here they've got revenues up 8%, operating profit up 30%. So lots of positives here. Now, they do carry a large net debt balance, and I guess in many ways the net debt reflects the fact that they've got this huge receivables balance, and so you have to fund your receivables somehow, and borrowing is a common way of doing that. So we've got a big net debt balance here. What else do I want to point out about it next? So let's scroll down to the outlook. It's quite a lot happening here. If you take a read through all these paragraphs, there's certainly can't be accused of standing still. Seems like they're hiring a lot of staff. And yeah, so there's a lot happening. But anyway, let's find the outlook statement. So current trading and outlook. As our financial performance and KPIs have demonstrated, the group has continued to invest in its people, particularly within the legal services division. That's Bond Turner. Supporting the growth we have reported in both the number of claims settled and the underlying level of cash receipts for the group. While this investment impacted our reported financial performance, the continued growth in headcount supporting ever-increasing case settlements will continue to contribute to growth in 2024 and beyond. And they say that trading has been in line so far this year. Pretty positive outlook here as well. So, I mean, on its face, if you're willing to take the PE multiple at face value here, it's very cheap. Personally, I'd be a little bit cautious of the situation here. Net debt of 68 million. That is about the same as the market cap. Now they do say it has reduced year on year, so that's something. But it's still quite a significant number. And then you scroll down and you look at the receivables and the balance sheet, and there's a huge amount going on here. Total assets over £250,000, to nearly all of it being receivables. So if you can get a handle on what's in that, what is in that number, and if you're confident in its value, then maybe this investment makes perfect sense and it's actually a bargain. Just scroll down here to the footnote, trade and other receivables. So here's the breakdown of what all of this is. And then in terms of aging, you can see that that there's some significant age involved here. Yeah, so there's stuff that's been there for a long time. So yeah, I must say I'd be a little bit cautious on this one until I had fully understood what was in the receivables. But on its face, a very cheap stock, and could be worth researching in more detail. Okay, let's go to Altitude. Altitude, a nice little company that I've studied before, and 26 million pound market cap. It's up 16.5% today. Interesting sort of growth opportunity here, I think. Again, one of my problems with this one is difficulty in understanding exactly where the growth is coming from. This is, this is very active in the United States, and yeah, it's. I understand the merchanting business that they have, which is simple enough, but then they've got other contracts with new customers, which I think do require some more research. But basically, a nice, interesting company. They say they are an end-to-end solutions provider for branded merchandise. So that's what they do in a nutshell. And they've experienced another strong year of trading, a transformative entrance into the collegiate market. So that's what they started talking about last year, where they had an agreement with Apple, which seemed quite significant. So anyway, current trading, they've got strong growth across their verticals, rapid scale in merchandising, and then in the services division, they've got steady year-on-year growth. And in April, so they've enjoyed a very strong start to the new financial year. So yeah, look, I think this is worth researching. I have tried to study it and I have found it rather difficult. But um, I would say if you have the interest, it is worth looking into it because it is growing very quickly and it is a real business. And you can see they've got cash of 1.3 million pounds. They have a US credit facility now without any significant financial covenants. So this is really I view this as a US based stock. Really, I think the UK business seems kind of less important, much less important than what they're doing in the States. So yeah, best of luck to them. Let me just check for you the current PE ratio on this one. Yeah, trading at 13 times earnings, and they've even been paying dividends as well, apparently, or with a dividend being in the forecasts apparently for altitude. Okay, let's move on from that one. So we'll do more of a household name now. So here's Wix. And so, yeah, this, as you know, this is a household name. And shares a little bit down today. Market cap £350 million. And this trading update was a little bit cautious. They use the word challenging. They also use the word uncertain. So yeah, a little bit cautious from Wix. I'd have hoped for a little bit better, given that things do seem to be improving for the consumer currently. But they have like-for-like sales down by 4.2% compared to the same period last year. They also say retail sales have demonstrated continued appeal. So it's not all bad, but yeah, a little bit. I was a little bit downbeat after reading this trading update. You look at the historic performance here, and it's quite a low margin business, which I guess makes sense. But yeah, the outlook here. The chief executive says the external environment remains uncertain, but our overall profit expectations for the full year remain unchanged. We continue to invest for future growth with our program of store refits, new store openings, and investment in technology and solar fast. Okay, well, I don't think there's any need to say much more about this, but if you're interested in retailing stocks, I think there's probably better ones than Wix, but it is trading at 10 times earnings, so could be an opportunity there if you are interested in retail. Okay, let's hop over to Maintel now. And I know Steve in the comments suggested Intelligent Ultrasound, so maybe we'll do that one next and have a look at that one. It's been a Wednesday, which is a very busy day for news, so you kind of get dragged in all directions looking at lots of different things. Here's Maintel anyway. So this company provides cloud and managed communications services. So maybe you could think of it as a managed services IT group basically, and there's plenty of them in the market. Market cap £35 million. We'll go into the RNS here. So these shares are down by 11%, and you can see we've got a loss of £6.8 million, which is quite poor considering that there's adjusted EBITDA of £9 million. So there's an enormous sort of chasm between adjusted EBITDA and the pre-tax loss. So basically a £16 million difference between the two numbers. They've also got net debt of £18 million. So the results table doesn't look great on that front. However, if you're willing to use adjusted EBITDA, well, that did double. and the top line was up by more than 10%. So, there are at least two positives there. What were some points that I noticed from this one? Okay, well, I think the outlook was reasonably positive. So we'll scroll down to that if we can. So the chief executive says, "We are strong. We have made a confident start to 2024 with trading at the end of Q1 being in line with management expectations. We continue to navigate challenging global macroeconomic and political issues, but they expect FY 2024 to reflect a consolidation of the progress made in 2023." So a reasonable outlook statement. And then the other point was just to show you the what they were putting in their exceptional items. Let's see, control find exceptional. So we'll just scroll down here. So they've got £7 million of exceptional items, which was mostly this business transformation project. So unfortunately, this is not a category, or this is not an adjustment which I would typically allow businesses to make, because I think businesses tend to have these transformation projects every few years. It's not really that unusual. So for me, I don't really allow this adjustment. But if you do, well, then these results will look much better to you. So unfortunately, there's not enough here for me at Maintel to take a positive view on it. But at £35 million, maybe there is some value to be had there. The shares are trading at 8 times earnings, according to Stockopedia. So I think that will be an adjusted earnings number, however. So after, if you don't allow those adjustments, then it's trading probably much more expensively than that. But I think, I don't have a hugely positive view on Maintel, I'm afraid. Okay, let's do this one, IUG. So as requested by Steve in the live chat, thank you very much. Intelligent Ultrasound is unlocking ultrasound for everyone by training clinicians in the classroom and then supporting and guiding them in the clinic with real-time AI-based image analysis software. So, and what does Steve say about this? Personally, I think this could be a good entry level. Not only does it look likely to become profitable this year, but could well be bought out. So thank you very much for sharing your opinion, Steve. Let me just check the metrics here. Yeah, so the track record here does show consistent losses, but are they making progress towards profitability? So they have revenue growth of 11%. Now, they also mentioned that the previous year included one-off orders. I don't know if I'd really adjust that out. As I said yesterday, I prefer just to use the actual numbers rather than to let companies say that this was a one-off piece of revenue, because one-off pieces of revenue can arise again. But anyway, thank you to the company for pointing out that there was a big order, fair enough, in the previous year. They say the loss reduced to 2.6 million from 3 million. So that's a small bit of progress there. And they have cash of 3 million, down from 7.2 million. So I suppose immediately I'm thinking, well, if they've burned 4 million in 2023, does that mean that they could burn another 4 million in 2024? And would they then need to borrow, perhaps? Now, I don't think it's the end of the world if a company has to borrow, but so if a company is borrowing, you certainly are going to want to see a move towards profitability quite soon. in terms of the outlook, the UK market is experiencing tougher trading conditions due to the current reduction in NHS capex spending, but anticipate growing revenue from high margin AI related products and non UK related simulation markets. So that is, well, mixed, let's say. They have implemented tight cost control on overheads, and they expect revenue in 2024 to be between 14 to 17 million pounds, and they continue to forecast that it will reach profitability with its current cash resources. So, I mean, they've put it in black and white there, and I think with a lot of small companies, it does come down to trusting management. There's no getting away from that. With a large company, there are institutional forces at work, which mean that a chief executive can only do so much damage, and the personal views of the chief executive don't really matter very much, and the board. But in this case, with a small company, they're really putting their reputations on the line here by saying that that's what they believe. And 14 to 17 million pounds of revenue would be a very decent uplift on the 11.2 million pounds for 2023. So that's promising as well. Let me just check some of the forecasts here. Yeah, 14 to 17 million. So it looks like the consensus forecast is 15.6 million pounds of revenue for 2024. What does the chairman say? It was another year of important progress. We achieved our number one target for the year, which was to grow artificial intelligence related sales to 2 million. They have a relationship with GE Healthcare, which continued to develop positively. And in Q4, we announced the first trials in Africa that will be using fetal check AI software to enable an unskilled user to automatically obtain the gestational age of a fetus. So, yeah, I can see where you're coming from, Steve. I mean, I think in this case, it's basically a question of trusting management. They've said that they're going to reach profitability, or that's what they forecast, with their current cash resources. It doesn't seem completely out of the question. If they reach their consensus forecast number, which is for an extra 4 million, well, say 4.5 million pounds of revenues, if this is software sales which have a low incremental cost, then a large chunk of that 4.5 million could drop through to profits to reduce the losses, and then maybe that means that they have a positive cash balance for they keep their positive cash balance this year, and then maybe 2025 they actually get into the black, into profitability. So I can see the argument, and I have looked at this company before, and I think I came away sort of neutral on it. I didn't have a strong view, but I could see that it had there were bullish arguments that could be made. See, now we've got expensed research and development of £1 million, which is down from the prior year. So that's interesting that they've maybe they're being a little bit more cautious now because they want to keep that cash balance. So maybe they've reduced R&D spending a little bit. In fact, here we have the gross R&D spending. So they didn't reduce their total R&D spending that much. They did reduce it a little bit. But they so we have to always be careful and watch out to see how much are companies expensing their R&D and how much are they putting on the balance sheet to avoid expensing it. So in this case, They are putting most of it on the balance sheet, it looks like, and they're expensing, some of it. Um, so yeah, a nice company. I have looked at it before, although not recently, and I was neutral on it. I'd probably be neutral on it again today. Just thinking that yeah, they have a chance, but I'd really need to look into management and see, on what basis can we trust management here that they will hit their targets. Okay, so that is intelligent ultrasound. Okay, now there was a bit of a bad news story that I wanted to mention. Inspiration Healthcare. So this is down 43% today. And what do? They develop outcome enhancing products for intensive care patients. Small company, £12 million market cap. Let me just pull up its report here. Okay, so as I said, a small company and smaller today in terms of market cap. It looks like it had a market cap of 21 million last night. Market cap only 12 million pounds now. So small and getting smaller. Today's trading update says, okay, further to the announcement on 31st of January, the company notes that the material export order that was due at the end of January remains outstanding. The company still expects to receive this order in the current financial year, but is not able to confirm a date due to factors outside of its control. As a result, the company has been in discussions with its bank regarding covenant tests on its debt facility and has sought and received a waiver from its lender in this respect. Alternate covenants have been agreed until April 2025, which will need to be met, and bank consent received ahead of any further drawdowns of the facility. The company is investigating alternate financing options in the event the order is not received, and will make a further announcement as appropriate. They also say that trading conditions are still challenging, and they expect sales to be significantly second half weighted, which is always bad news in my experience. Nobody ever wants to hear that sales will be weighted to the second half, because it just means there's some kind of a delay. So unfortunately, this one could be a zero. I mean, it's too soon to say that they're doomed. Clearly, they still have a chance, but it's very bad news, and they're kind of at the they're at the mercy of the bank, which can decide what it wants to do when covenants are broken that were previously agreed. They also seem to be at the mercy of their customer, because if they don't get this order that they're waiting on, then they are looking at alternate financing options. So presumably that means raising equity. It could mean something else, but my assumption would be that it's referring to equity. So unfortunately, guys, that's a bad news story, and it could be a zero. Let's hope not. Okay. I think I might wrap it up there. Before I do, let's just see what's on the homepage here at Vox. So we've got an article on altitude. We've got intelligent ultrasound mentioned. So Steve there might be interested in that article. Got a few other bits and pieces. Most read RNS. Supply Me Capital always seems to make it into this list. We've got Upland Resources, request for suspension, UK Oil and Gas, And then in the top risers for the day, a few stocks there. We've already mentioned Altitude is in there, Alpha Financial Markets, and so on. Inspiration Healthcare that we've just covered is the top faller today, and Intelligent Ultrasound is in there too. So in terms of today, it looks like we've got a US Fed rate decision coming up this afternoon that will be of interest to traders. So that should be out fairly soon. And that's it, folks. That's your Wednesday market update. Hope you've enjoyed the show. Please, if you'd like to do me a favor, hit that thumbs up button. It helps out very much. And hope you enjoy the rest of your day. It's been a pleasure. And I'll talk to you all again very soon. Okay, thanks. And bye for now. Cheers.